Welcome back to the deep dive. Today we are opening a file that feels less like a standard corporate earnings report and more like a season of Succession set in Italy.
That's a great way to put it.
We're looking at a dynasty that has practically defined European industry for over a century. We are talking about Exor NV.
It is a fascinating case study. For those tracking the tickers, it's EXXRF. And you're right about the Succession vibe. This isn't just a company. It's the Agnelli family empire.
Right.
In Italy, they're treated with the same reverence and, scrutiny as the Kennedys in the U.S. or maybe the royal family in the U.K.
That's the glamour part. You think Agnelli, you think Gianni Agnelli jumping off a yacht in the Mediterranean, wearing his watch over his shirt cuff. It's this image of effortless style.
Absolutely, the sprezzatura.
But we aren't here for the lifestyle corn. We are here to figure out if this holding company is actually a good place to park capital in 2026.
Precisely. And that requires stripping away all of that mystique. When you buy Exor, you aren't getting an invite to the yacht.
Unfortunately.
You are buying a portfolio of businesses. And some of them are incredible, truly world-class assets. Others are, well, let's just say they are heavy, rusty, and facing some pretty existential threats.
So the mission today is to apply our skeptical framework. We aren't looking for good enough. We want to know if Exor meets the bar of an exceptional long-term investment.
Exactly.
Is this a compounder that will make us rich over the next decade? Or is it a classic value trap where money goes to die slowly?
That is the goal. And to do that, we have to evaluate Exor not as a manufacturing company, because they don't actually make anything themselves, but as an allocator of capital.
As an investment firm.
As an investment firm. And we need to look at the big four holdings that make up, about 75% of their net asset value?
Which are?
Ferrari, Stellantis, CNH Industrial, and Philips.
And the hook here, the thing that brings all the value investors sniffing around, is the discount.
Right, the discount. Exor consistently trades at a 40 to 50% discount to its net asset value, or NAV.
Okay, so just to make that really clear for everyone, what does that actually mean in practice?
It means if you added up the market price of all the shares of Ferrari they own and all the Stellantis and all the Philips, and then looked at Exor's own stock price, the market is offering you those assets for 50 cents on the dollar.
Which sounds like a no-brainer. If I offered you a $100 bill for $50, you'd take it.
You'd take it in a heartbeat.
But in the stock market, there is usually a reason for a discount like that. It's rarely a free lunch. It's usually a warning sign.
Exactly. Is it a bargain? Or is the merchandise damaged? To find out, we need to break this down into three parts. The jockey, that's management, the horse, the portfolio itself, and the odds, which covers valuation and risk.
Let's start with the jockey. You can't talk about Exor without talking about John Elkann. He's the current head of the family, the CEO, and honestly, his origin story is crucial because he wasn't supposed to be the guy, was he?
No, he wasn't. Not at all. He was the spare, not the heir initially. But due to some really tragic family circumstances, he ended up with the crown at a very young age.
Right.
And to understand how he thinks, you have to go back to 2004. This is really the origin story of the modern Exor. It's the crucible that forged him.
The dark days of fiat.
Dark is an understatement. Fiat, the family's core car business, was technically bankrupt. I mean, the banks were circling. The business was bleeding cash every single quarter.
And the consensus in the financial world was that the Italian auto industry was just done, finished.
Yeah, it was a basket case. And here comes young John Elkann. The pressure on him must have been absolutely crushing. He had the weight of a 100-year legacy on his shoulders, and everyone expected him to fail.
So what did he do? Did he try to roll up his sleeves and run it himself, play the hero?
And that's the key. He didn't. He had the self-awareness to recognize he wasn't a car guy. He wasn't an operator. He was an owner.
So he made a hire.
He went out and hired Sergio Marchionne.
A move that is now legendary in business circles.
It is. Marchionne was a force of nature. He was this Italian-Canadian accountant who always wore a black sweater. He slept in the office, he was famously blunt, and he was completely ruthless.
So Elkann just unleashed him.
Elkann gave him the political cover to do what needed to be done, to fire layers of entrenched middle management, to fight the powerful unions, and eventually to pull off the audacious merger of Fiat with a bankrupt Chrysler.
A move that nobody thought would work.
Nobody. But that single decision hiring Marchionne didn't just save the company, it saved the family fortune. And it proved that Elkann has the most important skill a holding company manager can have. He knows what he doesn't know.
And he's willing to let experts execute. That leads us to the value unlocking phase a bit later, around 2014 to 2016. This is where the portfolio we see today really took shape. Let's talk about the spin-off of Ferrari.
Yes.
Now, looking back, this seems so obvious. Ferrari is a luxury brand, Fiat is a commodity brand. You separate them. But at the time, was it seen as a genius move?
It was seen as aggressive. For decades, Ferrari was just a shiny hood ornament buried inside this massive, messy Fiat conglomerate.
Right, it was just another division.
It's just another division. So the market was valuing the whole bundle at a low automaker, multiple, say, 4 or 5 times earnings. It was being dragged down by the perception of Fiat.
Okay.
But Elkann and Marchionne realized that if you pulled Ferrari out, polished it up, and presented it to the market on its own, investors wouldn't value it like Ford. They'd value it like Hermes or Louis Vuitton.
At 30 or 40 times earnings.
Exactly. So by simply moving the asset into a separate box, they created billions and billions of dollars in value out of thin air.
It was financial engineering at its finest.
Absolutely. And it proved a critical point for investors. Exor wasn't just a museum for hoarding family trophies. They were willing to dismantle the empire if it made shareholders richer.
But saving Fiat and spinning Ferrari is history. That's 10 years ago. What has he done for us lately? I want to look at the sale of Partner. This story, I think, really reveals Elkann's temperament as a capital allocator.
This is my favorite Elkann story because it shows his capital discipline in a moment of extreme pressure. So Exor owned Partner, a big reinsurance company.
Boring but profitable.
Very boring, very cash generative. In early 2020, just before the world changed, Elkann strikes a deal to sell it to a French insurer called Covéa for about $9 billion.
Great deal. Everyone's happy. He's cashing in a mature asset.
And then March 2020 happens. COVID shuts down the entire world. Markets are in a complete free fall.
I remember it well.
The French buyers, Covéa, get cold feet. Understandably, maybe. They come back to Elkann and basically say, look, the world is ending. We can't pay $9 billion. We need a discount.
And most sellers in that moment would have panicked. Cash was king. You take the haircut just to secure the liquidity, right? I mean,
Yeah.
your bankers are probably screaming at you to take the deal.
That's what 99% of CEOs would have done. But Elkann said no. He basically told them, the contract is the contract. This is a quality asset. If you don't want to pay the agreed-upon price, the deal is off. And he just walked away from $9 billion.
That is ice in the veins. To walk away from that much cash in that environment.
It is. He held on to Partner for another year or so. The business continued to perform well. The world didn't end. And eventually, Covéa came back to the table.
And guess what?
Elkann sold it to them for the original valuation. Not a penny less.
So he didn't blink. He called their bluff and won.
He didn't blink. And then, and this is the strategic shift we are in right now, he took that $9 billion pile of cash, and he didn't just buy another boring industrial company. He pivoted.
This is where it gets interesting.
This is the new chapter. He started deploying that capital into healthcare, buying a huge 15% stake in Philips, and into luxury fashion, like a stake in the shoe brand Louboutin. He is actively trying to move the empire from grit to science and style.
Okay, so he's disciplined, he's strategic, he's forward-looking. But we promised a skeptical view. Is he too sentimental? Because there are some assets in this portfolio that, frankly, smell like rotting fish financially, yet they are still there.
You're talking about the legacy risk.
Yeah.
And yes, the elephant in the room is Juventus Football Club.
That soccer team.
Look, from a purely cold-blooded capitalist perspective, owning a sports team is usually a terrible idea. It's a vanity asset. Player salaries spiral up, revenue is totally dependent on winning, and winning involves a whole lot of luck.
And Juventus has been a money pit.
A black hole for cash. In late 2023, Exor had to inject 80 million euros just to plug holes in the balance sheet. And that wasn't the first capital call, and it probably won't be the last.
And didn't they have a chance to sell it for a pretty decent price?
Reportedly, yes. There were rumors of a 1.3 billion euro offer from a crypto-related firm. Now, if you are a ruthlessly rational allocator like a Warren Buffett, you take that money and you run.
Of course. You put it into something that actually generates a return.
You put it into tech, or you buy back your own deeply discounted shares. But Elkann didn't sell. Why? Because the acknowledgers are Juventus is part of their identity in their home city of Turin. It's about prestige, not profit.
So the family legacy does override financial logic in some places.
In specific pockets, yes. Juventus and GEI, the Italian newspaper group they also own, are clear drags on the portfolio. They are there for influence and emotion, not for compounding capital.
And as a minority shareholder, you are essentially subsidizing the family's hobby.
That's the harsh truth of it. You're along for that ride whether you like it or not.
That's a crucial point for the cons column. But let's move to the main event, the portfolio, the horse. If Elkann is the jockey, what is he riding? We have to start with the main engine, Ferrari.
Ferrari is the reason most people buy Exor. It's roughly 35 to 40% of the net asset value. And we need to be very, very specific about why Ferrari is a great business. Because it's not about horsepower. It's not about the cars, really.
It's the brand mode.
It's the economics of the brand. And the most beautiful part of the Ferrari business model is that it has negative working capital.
Okay, explain that like I'm 5. Because negative working capital sounds like they are losing money. It sounds bad.
It's the opposite. It is the absolute holy grail of business models.
Yeah.
Think about a normal car company like Ford or GM.
Okay.
Ford spends millions, billions buying steel, rubber, glass, electronics. They build the car. It sits on a dealer lot. Then maybe months later you come along and buy it. Ford is out of pocket that whole time. Their cash is tied up.
Right. They tie up their capital in inventory hoping to sell it.
Exactly. Now look at Ferrari. You walk into a dealer, you want to order a custom Puro Sang. They tell you there's a 2-year waiting list.
Okay.
And crucially, to get on that list, you put down a massive non-refundable deposit. Ferrari takes your money today and uses it to buy the leather and the engine parts to build your car tomorrow.
So the customer is financing the production of their own car.
Precisely. They are operating with other people's money. It means they don't need to borrow heavily to grow.
Yeah.
And you combine that with their insane pricing power.
Where they can raise prices 10% and demand actually goes up because it becomes more exclusive.
It's a Veblen good. The higher price is a feature, not a bug. It's a financial fortress. There are very few businesses like it on Earth.
Okay, so Ferrari is the straight-A student, the crown jewel, but now we have to talk about the problem children, and there are 2 big ones. Let's start with Stellantis.
Stellantis is the value trap risk. This is the company formed by merging Fiat, Chrysler, and the French group Peugeot. It owns Jeep, Ram, Dodge, Maserati, a huge portfolio of brands.
And on paper, for the last few years, it has looked incredibly cheap.
Deceptively cheap. But recently, the wheels have really come off.
The numbers for 2024 were horrific.
They were. Profits collapsed down something like 64% year on year. And the operating margins, which used to be in the healthy double digits, fell to 5.5%.
And for an automaker, 5.5% is.
It's the danger zone. That means you have almost no room for error. A small dip in sales, a rise in steel prices, and you're losing money.
So what happened? I thought the whole point of merging all these companies was scale. Being the 4th largest automaker in the world was supposed to be the moat that protected them.
Scale was the thesis. And Carlos Tavares, the CEO, was brilliant at cutting costs and finding synergies. But scale only works if you are efficient and you're selling cars people want at the right price.
And they weren't.
Stellantis ran into a massive inventory problem, specifically in the U.S. with their most profitable products, Jeep and Ram trucks. They kept shipping vehicles to dealers, treating them as sold on their books, but nobody was actually buying them at the consumer level because they had hiked prices too aggressively post-COVID.
So they stuffed the channel, a classic accounting trick.
They stuffed the channel, and now they have to offer huge discounts to clear that metal, which absolutely destroys margins. But the bigger problem is structural. It's not just a one-off inventory issue.
You mean the EV transition?
The moat of mass-market autos is evaporating.
Yeah.
You have Chinese EV makers like BYD entering Europe with good cars at unbeatable prices. You have Tesla winning the software war. Stellantis is this massive, lumbering industrial giant trying to learn how to dance while the floor is crumbling beneath it.
And this isn't a small part of Exor. It's a huge chunk of the NAV. If Stellantis fails to pivot, it's a giant anchor tied to the portfolio.
It is. And unlike the 2004 Fiat crisis, I'm not sure simply cutting costs and being tough with the unions is going to fix it. This is a technology and product crisis, not just a labor crisis.
A much harder problem to solve.
Much harder.
Let's talk about the other turnaround bet,
Yeah.
Philips. This is the big healthcare play. And this one has a horror story attached to it, doesn't it?
It really does. Philips is a classic contrarian bet by Elkann. He bought that 15% stake right in the middle of an absolute disaster.
What happened?
Philips had to recall millions of their sleep apnea machines, CPAP machines, because the sound dampening foam inside them was degrading.
Degrading into what?
Degrading into toxic particles that users were potentially inhaling while they slept. There were fears it was carcinogenic.
Oh, that's bad.
You can imagine the lawsuits. The stock price was decimated. It lost something like 70% of its value from the peak. The brand was in tatters.
And Elkan looks at this burning building and says, I'll take 15%, please. Why? What does he see that the market doesn't?
He believes the fire is temporary, but the address is prime real estate. His thesis is that the long-term trends are undeniable. The world is aging. We need more diagnostic machines, more hospital equipment, more home monitoring.
And Philips is a leader in that technology.
A global leader. He thinks the recall, as terrible as it is a fixable legal and operational problem. He's betting that once the lawsuits are settled and they fix their quality control, the underlying business is a cash machine with huge tailwinds.
It's a classic value investor move, buying good assets when they are temporarily hated. But it's risky. Exor knows cars and industry. Do they know medical devices?
That's the big question. It's a major step outside their circle of competence. If he's wrong, he just caught a falling knife and lit a pile of money on fire. If he's right, and Philips recovers to its old highs, he could easily double or triple his money.
Briefly, let's just touch on CNH Industrial, the tractors and construction equipment.
CNH is less dramatic, but still a headwind right now. It's a deeply cyclical business. Farmers buy new tractors when crop prices are high and they're feeling flush with cash.
Which they are not right now.
Right now, farm incomes are down globally, so tractor sales are down. It's a waiting game.
Right.
Exor is comfortable waiting, that's their nature, but it means CNH is dragging down the overall performance in 2024 and likely into 2025.
Before we move to the valuation, I want to touch on the future. You mentioned Exor Ventures and a company called Legato. What are those?
These are the seeds for the future. Legato is their attempt to build an in-house asset management firm, essentially, managing money for other wealthy families, not just the Ignellis. Trying to build a Blackstone or KKR.
And Ventures?
Ventures is their early-stage tech fund, investing in AI, robotics, fintech. These are far too small to move the stock price today, but they show where Elkan's head is at. He wants the future of Exor to be less steel and rubber and more silicon and spreadsheets.
A very clear strategic direction. All right, section 3, the odds. Let's talk valuation. We established that Exor trades at a, say, 45% discount to the sum of its parts. I want to push back on this. You call it a discount. I might call it a complexity tax.
A fair point.
Why isn't the market right? If I buy Exor, I have zero control. I can't fire John Elkann. I can't force them to sell Juventus. I can't tell them to put all their money into Ferrari. Why shouldn't I demand a 50% discount for that total lack of agency?
That is the strongest bear argument against Exor, and it's why the discount exists. It's the classic conglomerate tax. Investors today, especially in the U.S., prefer pure plays. If I love the Ferrari growth story, I could just go buy the ticker ANCE on the New York Stock Exchange.
Right.
It's clean. Why should I pay John Elkann a management fee, essentially, to hold it for me? Especially when he's also going to make me own a struggling tractor company and a money-losing soccer team.
Exactly. So is the discount actually an opportunity, or is it just a permanent feature of the stock, a value trap?
It becomes an opportunity if management takes specific actions to address it. And this is where the capital allocation strategy becomes so critical. Exor knows their stock is too cheap. They talk about it all the time.
So what are they doing about it?
They are buying it aggressively.
Mapbacks.
Massive buybacks. They recently spent €1 billion canceling their own shares, sometimes through big tender offers. Think about the math here because it's really powerful.
Go on.
Let's say Exor has $100 of assets per share, but the share price is only $50. Every time they spend $50 to buy back one share, they are retiring a $100 claim on the underlying assets.
So the pie doesn't shrink, but the number of slices does.
Exactly. The remaining shareholders instantly own a larger slice of Ferrari, of Stellantis, of everything. It's risk-free accretion of value.
It's the most intelligent, shareholder-friendly thing they can possibly do with their cash as long as that discount stays so wide.
It is. It's effectively buying Ferrari shares at half price. It also sets a soft floor under the stock price, because you know there's a huge price-insensitive buyer in the market.
What about their debt? Because you can't do buybacks if you're drowning in debt.
Their balance sheet is a fortress. Their loan-to-value ratio, or LTV, is usually under 10 or 15%. They sit on a mountain of cash.
And that's critical because
It means they are never a forced seller. If we hit a deep recession and Stellantis has to cut its dividend completely, Exor doesn't have to panic and sell assets at the bottom. They can weather the storm. They have staying power.
However, we do have to look at the scoreboard, the returns. Historically, their NAV growth was incredible, around 18% per year. That's Buffett-level compounding. But 2024, not so much.
No, 2024 was a reality check. Exor underperformed the MSCI World Index pretty significantly. And this is important for you, the listener, to understand. Exor is not an S&P 500 proxy. It's a very specific, concentrated bet.
It's not a market ETF.
Not at all. When big tech, your NVIDIA's, your Microsoft's, is driving the market, Exor is going to lose. Exor is a bet on European luxury and global industry. And when industry struggles, like it did with Stellantis and CNH in 2024, Exor will lag, even if Ferrari is doing well.
Which brings us to the pre-mortem, section 4. I want to play out the nightmare scenario. Let's imagine we're looking back in 2030 and Exor has been a disastrous investment. What happened?
The first and most obvious failure mode is concentration risk. We talk about it being diversified, but that's an illusion. 70% of value is tied to just 3 companies: Ferrari, Stellantis, and CNH.
And 2 of those are auto companies.
2 of those are in the direct crosshairs of the biggest technological shift in a century, the death of the internal combustion engine.
Let's paint the Stellantis value trap scenario. Make it scary.
Okay, here's the nightmare. It's 2028. Chinese EVs from BYD, NIO, and others continue to improve, and they start taking 20, maybe 30% of the mass market in Europe.
Okay.
Stellantis' sales for Peugeot, Fiat, and Opel just plummet. They try to close factories in Italy and France to save money, but the governments, fearing mass unemployment, say, no, you can't. The unions go on a massive, crippling strike.
So they're stuck. They have these huge fixed costs and collapsing revenue.
They're stuck paying for idle factories.
Yeah.
Cash flow dries up completely. The dividend, which Exor relies on, is cut to zero.
And since Exor uses that dividend to fund its own operations and buyback.
Exor's own cash flow chokes. They have to stop the buybacks. The market looks at Stellantis and values it at or near zero. Suddenly, the net asset value of Exor collapses.
So the discount doesn't matter.
The discount doesn't matter because the underlying asset is melting like an ice cube. In this scenario, Exor becomes just a weirdly expensive and complicated way to own Ferrari with a giant dead weight attached to its ankle.
That is a terrifyingly plausible picture. What about the governance risk? We mentioned the Prince problem earlier, with Elkann having total control.
The risk is hubris. John Elkann is, for all intents and purposes, a monarch. He controls 86% of the voting rights. If he decides tomorrow to sell all the Ferrari stock and invest everything in a flying car startup that goes to zero, nobody can stop him.
Minority shareholders are just passengers.
You are betting entirely on his judgment. And if he suffers from style drift, if he starts thinking he's a genius in healthcare or tech when he's really a car and industry guy, he could destroy value very, very quickly. The Juventus situation is a small-scale warning sign of that.
And finally, the third nightmare, the discount trap.
This is the slow, boring death. The company does fine, the assets grow modestly, but the market simply stops caring about complex holding companies. The discount, instead of narrowing, widens to 60 or even 70%.
So you could be right on the assets.
You could be right on the assets, but you make no money. You hold the stock for 10 years, the NAV grows, but your stock price barely moves because the market just keeps penalizing the structure. Yeah. You end up with dead money and a huge opportunity cost.
All right, we've dissected the jockey, the horse, the odds, and the nightmares. It's time for the verdict. Exor NV, is it a great investment? According to our framework.
Based on our rigorous skeptical framework, I have to rate Exor as good, not great.
Okay, break that down. Why does it miss great? What's the key factor holding it back?
It misses great because of the baggage. A truly great investment usually has a singular compounding focus. Think of Costco or Microsoft. Exor has a diamond Ferrari, but it's wrapped in rusty iron. That's Stellantis and CNH.
So it's the complexity.
The complexity and the deep cyclical risks prevent it from being a set-it-and-forget-it compounder that you can just own forever without worry.
But it's good.
It's good because of the price you pay today. The margin of safety is enormous. At a 45% discount, you are essentially buying Ferrari, one of the best businesses in the world, for a massive discount, and you're getting a free option on the Stellantis turnaround and the Philips recovery.
So what's the play for you, the listener? How should you think about this?
I think you should think of Exor as a backdoor entry to luxury. If you love the Ferrari story, but you look at the stock and can't stand at the high valuation, you should look at buying Exor.
You get the Ferrari exposure at a discount.
You get the Ferrari exposure at a discount, and you get paid to wait, through buybacks and dividends, for John Elkann to fix or sell the other parts of the business.
What are the specific triggers? If someone buys this, what should they be watching for over the next few years?
2 things, primarily. 1, watch Stellantis' EV market share in Europe. If that number stabilizes and starts to tick up, the value trap thesis is probably wrong and the stock is too cheap.
And the second thing.
2. Watch for simplification. If you wake up one morning and read that Elkan has sold CNH or spun off Phillips in a few years, that proves he is dead serious about closing the discount. That is the ultimate catalyst for a major re-rating of the stock.
And I want to leave you with one final thought. We've spent an hour talking about cars and tractors and balance sheets, but if you look at where the new money is going, into ventures, into Lingotto, into healthcare, Elkan is clearly trying to mutate the company.
Right.
It's a slow pivot.
There is a version of the future where Exor in 2035 looks nothing like Exor in 2025. Maybe it succeeds in becoming the Berkshire Hathaway of Europe, a diverse collection of high-quality, capital-light assets with no ties to the Rust Belt.
That's the dream scenario.
And if that pivot happens, growing today at a 45% discount might look like the heist of the century in hindsight.
That is the ultimate bull case, that the caterpillar is struggling today because it's trying to become a butterfly. We just have to hope the metamorphosis doesn't kill it first.
Fascinating stuff. A dynasty in transition, trading for 50 cents on the dollar. As always, none of this is financial advice. Please do your own due diligence. Check the show notes for the charts on that crazy negative working capital we talked about. Thanks for diving up with us.
Always a pleasure.